Hi, my name is Tiana with Leapers Connect Consultancy, and welcome back to another video. I was just so hyper there. I hope I haven't knocked your eardrums out with that high. So today's video is about SCorps. We're going to go over the election rules and taxes, just a general overview so you can understand what an SCorp is, because there's a lot of noise on the internet, on TikTok, and those YouTube and Insta shorts. So I'd like to just help you to understand the responsibilities of becoming an S-corp and the benefits. All right, so let's get started. My firm is Leapers Connect Consultancy. We are business consulting and tax professional group. We specialize in tax strategies for business consultants and real estate investors. So our services include tax preparation, tax resolution, and tax planning, business consulting, and bookkeeping. All right. So let's just jump right into it. An S Corp provides the benefits of lowering self-employment tax where applicable, right? So what exactly is an S Corp? An S Corp is an election you make with the IRS to change the way your business is taxed. It has to be approved by the IRS. It's not something you do at the state level. So you can't, just like you register an LLC, you can't register an S Corp with your state, right? You can't go to LegalZoom and register an S Corp. It's an election that's made. So you register your entity, whether it is an LLC or a corporation, and then once it's registered and you get your tax ID, then you can make an election with the IRS to request to be approval to be taxed as an S corp. So who can make an election of S corp? LLCs, corporations, some estates, and some 50c3 entities. And let's continue on from here. So let's talk about the key features. One thing you'll hear is pass-through of taxes. What pass-through of taxes means is that you end up paying the taxes. So the tax information is passed from the S corp to you, and then your tax liability or tax liability would be determined from that. So just to elaborate a little bit more, the S corp files an information return. It's then gives you a tax form called a K1, and I'll go through that. And that K1 is used to prepare your personal return, and from that you'll determine your tax liability. All right, that's just what that pass-through of taxation means. If you register an LLC and then you elect to be taxed as an S corp, then you'll generally get whatever protection that LLC provides. Um, and then, of course, this is the part they don't tell you about. An S corp lowers self-employment tax where applicable, but it does not completely eliminate it. Your self-employment tax is still accounted for when you run payroll. So you have to pay yourself reasonable compensation. And what that means is whatever role it is that you perform in the company, whatever services you perform in the company, that is going to be if you should pay someone for that role, whatever the market rate is for that, for your state, whatever the local rates are, that's what you have to pay yourself. You have to put yourself on payroll and the works. So we just spoke about it's a pass-through of taxation. So you pay the taxes on your personal return. If you register an LLC, then you get the protection of the LLC. You have to pay yourself reasonable compensation. So if the business makes, let's say, 300,000, and you're doing a role that normally you'd pay someone 60 or 40,000 for, you can't pay yourself 5,000, right? There are penalties that would apply for that, and the IRS will come after you for doing that. So another thing to mention is you can't have more than 100 shareholders. S Corp owners are not called owners, they're called shareholders, right? So you can't have more than 100 shareholders generally. There are exceptions to that, but it's very unlikely that you're going to have more than 100 shareholders if you're watching this video. If you do, the exception is, let's say you have 99 shareholders. If the other two are family members or husband and wife, including husband and wife. So you have 99 and you brought on two and their husband and wife, they can be counted as one. And then, so that 99 would become 100. That's just what that means. There can be only one class of stock. It means you have to follow the laws and clause of the S-Corp. If you have, let's say, three people in one class of stock means if you have like three people in the LLC and one person has 33% shares, the other person has 33 and another person has 34, so that will equal to 100%. If a distribution is taken, right? If they're going to take money out of the S-Corp, that's different from your share of the profits, it's called a distribution. And that money that's taken out has to be split per the percentage share. So if it's 33% that you have a share, you're getting 33% of that. The other person is getting 33%. The other person's getting 34%. So that's what that means. If you don't follow those rules, you can lose your S-Corp election, right? Another thing is you save on self-employment taxes. Generally speaking, you don't eliminate it completely, right? You still have to pay yourself reasonable compensation, especially if it's just you or you and another person and you're providing services to the S-Corp, like you're working in the S-Corp to keep the business afloat, right? And let's keep going. Now let's go into the payroll. Payroll means like full-blown payroll, not, I do what I want. I'm not going to be consistent with it. There are penalties. So you are treated like they call it officer wages. So you're treated like an officer of the S Corp and you get a W-2. So it means you have to be consistent with the payroll, right? You have to set up payroll with your state, set up unemployment, pay those unemployment taxes, pay over those estimated taxes, quarterly filings with the IRS, and you have to do it, be diligent about it. So oftentimes when you get an S Corp, bookkeeping is generally recommended and required, right? Also saves you the stress of being not compliant, right? Saves you the stress of not being compliant. So who can file? When do you file? Generally, you file March 15th if you are on a calendar year, right? If your tax year is different, if you change and requested a specific tax year, then that's a tax year you follow. But generally, it's March 15th. If you miss that tax date, the fine's hefty. So let's say there are two persons in an S Corp, right? If there's more than one person in the S Corp, or it doesn't even matter, you pay 200, I think it's $235. I have to look at the exact figures. Don't quote me on the exact figures, but I know it's more than $200 per shareholder, right? That's what you are called when you're a part owner of an S Corp or a full-blown owner. You're called a shareholder. It's more than $200 per month, per shareholder, and you go all the way to the end of the year. So that can easily run you over $5,000 in penalties. And oftentimes you cannot abate that. You just have to pay it. All right, so things to consider, state and federal penalties. You still have to file a return, an S-Corp return, even if there was no income for the business, right? You still have to file it in a timely manner. So if the S-Corp didn't make any money 1 year, you still have to file an S-Corp return unless you have already filed a final return and closed it out, right? Prior to the filing date. And then another thing is bookkeeping is generally required. I believe I just said that before. It's required because you want to keep track of how money is going in and out of the S Corp. And per the IRS, if the S Corp's made more than $250,000, I have to look at the figures. If it's made more than a certain amount, you are required to provide the information from the balance sheet and your profit and loss statement. And you generally only get that from actually having up-to-date bookkeeping, right? So that is pretty much, let's see. All right, and then the forms that you consider is the 1120S, which is the SCorp return, and I'll show you what that looks like shortly. The K1 and the 1040, and that includes the Schedule E, which is where the information from the K1 goes directly before it gets to the main 1040 summary, right? If you have any questions, let me know, but let's go through what the form actually looks like. Right, so this is the 1120S form. This is what it looks like, right? Um, we already spoke about the deadlines and all that. So the information once you do the 1120S, each shareholder will get a K1. If it's just you, you'll get a K1, and that K1 will provide the information of your share of the business's income and all that. And then that goes on your Schedule E of your 1040, and then it shows up on your 1040, and you'll see it in the area of line 8. So on line 8 of your 1040 is generally where it is. And then bookkeeping is required. And I'll show you why I say that. This is Schedule L, which is a balance sheet. The information from the balance sheet goes here. And then, of course, the profit and loss statement will go on the first page, right? Gross income, and then your expenses would be entered. And then let me show you where exactly the IRS says it. So if the total receipts, like total revenue, is $250,000 or more, and you have assets of $250,000 or more, you have to file Schedule Ls, which is the balance sheet, right? Which is why you need bookkeeping, the balance sheet, and Schedule M1, which comes from the balance sheet and profit and loss statements. Okay. Hopefully this video was helpful, and let me know if you have any questions. All right, and we will take care of you. So we do offer bookkeeping services. And we do offer tax planning services. So this is something we can take care of, and we can also make that SCorp election for you and do a session to see if it makes sense for you. All right. Thank you, and you have a great day. We'll see you in the next video.